In retirement, every dollar counts. Ensuring your hard-earned savings will last requires careful planning and consideration, especially when it comes to taxes, which we all know will continue. In this installment of our series on wealth protection and planning for retirees, we'll discuss 4 tax saving strategies that could lower your tax burden and potentially enhance your retirement income. My name is Chris Zekis, and I'm a certified financial planner and managing partner at Zekis Wealth Management. At Zekis Wealth Management, we have one singular focus: to use our financial planning and tax expertise to help multi-generational families and business owners achieve more of what they love. In line with that focus, the purpose of these monthly videos is to give you actionable advice that may be used to improve your and your family's financial outlook. It's often said, it's not what you earn, but what you keep. In retirement, strategic tax planning is paramount to keeping more of your income in savings. So let's explore 4 tax saving strategies that could help you minimize your tax liabilities. Tax saving strategy number 1 is optimal asset liquidation. Timing plays a pivotal role in asset liquidation to reduce your tax burden during retirement. To benefit from favorable tax rate, you will need to leverage long-term capital gains to your advantage. As just a brief reminder, capital gains refers to the increase in the value of an investment or a real estate property over its purchase price. The capital gains tax that you pay on this profit varies depending on how long you've held the asset. If you sell an asset after owning it for less than a year, it's considered a short-term capital gain and is taxed at ordinary income. This tax can be a considerable amount if you're in a higher income tax bracket. However, if you hold the asset for more than a year before selling it, it's considered long-term capital gain. Long-term capital gains are usually taxed at lower rates, which can be 0, 15, or even 20%, depending on your taxable income. Now, there are also some timing strategies during the year to consider when liquidating an asset. For instance, let's say it's late in the year and you're planning to liquidate a sizable asset that would push you into the next tax bracket if you sold it this year. Instead, you might decide to sell a portion this year, staying within your current tax bracket, and then sell the rest of it early in the following year when the tax bracket's reset. This is a very simplified illustration, and the situation is much more complex in reality. Also, deciding to liquidate an asset has tax implications and affects your overall investment strategy and financial goals, so it's always wise to consult your tax and financial advisors. Our second tax reducing strategy is to optimize your retirement income distribution. Remember, different types of accounts have different tax implications upon withdrawal. For example, if you have 3 primary accounts, a taxable account, a traditional IRA, and a Roth IRA, when you withdraw from each, the tax consequences are quite different. In your taxable account, you own assets that have appreciated over time. When you sell those assets, you will likely incur capital gains tax. However, if you've held those assets for over a year, as mentioned, they qualify for long-term capital gains rates, which are typically lower than ordinary income tax rates. In your traditional IRA, though, your contributions have likely been made pre-tax, which means that those withdrawals in retirement are taxed at your ordinary tax rate. Depending on your overall income, these withdrawals could potentially bump you into a higher tax bracket. Meanwhile, in your Roth IRA, because you contributed post-tax money, your withdrawals in retirement, including both contributions and earnings, are generally tax-free. Now, let's look at an example. Suppose you need an additional $50,000 for a major expense in retirement. If you take it all out of your traditional IRA, your taxable income for the year could be substantially higher, potentially moving you into a higher tax bracket. Alternatively, if you take a portion from your taxable account, paying long-term taxable gain rates, assuming they've been held for over a year, and then you take the rest from your Roth IRA, which does not increase your taxable income, you can spread out that tax impact. Now, the best strategy for you will really depend on your specific circumstances, including your income needs, your tax bracket, your investment portfolio, and your overall financial goals. The third tax saving strategy is planning for required minimum distributions. Required minimum distributions, or RMDs, are mandatory withdrawals that you must start taking from your tax-deferred accounts, such as 401ks, traditional IRAs, and other similar accounts once you reach a certain age. The current age for RMDs to begin is 73, but due to recent legislation, this age is changing, so be sure to keep up with the current IRS rules as they can change. Planning around your RMDs can be a potential tax saving strategy for retirees because these distributions are counted as taxable income, which could push you into a higher tax bracket if not strategically planned. One of the most effective ways to optimize RMDs is to start withdrawals earlier than required. If you're in lower tax brackets in the years leading up to age 73, it could be beneficial to start withdrawals and pay taxes at your lower rate. This strategy could help then reduce the size of your RMDs later on, helping to manage your future tax brackets. Another approach is to convert a portion of your tax-deferred accounts to a Roth IRA in the years before you must start taking RMDs. While you owe taxes on the amount converted, Roth IRAs do not have RMDs and withdrawals are tax-free. This strategy can help reduce the size of future RMDs and provide tax-free income in retirement. If you have a significant amount of assets in tax-deferred accounts, you might also consider qualified charitable distributions. Qualified charitable distributions allow you to directly transfer funds from your IRA to a qualifying charity, which then counts towards your required minimum distribution, and thus are excluded from your taxable income. Remember, when it comes to RMDs, a strategic, thought-out approach can have a significant impact on your tax situation and your retirement income. Now, the fourth tax-reducing strategy we will look at today is utilizing tax credit. Taking full advantage of available tax credits is another way to reduce your tax burden in retirement. Unlike reductions, which reduce the amount of income subject to tax, credits reduce your taxable liability dollar for dollar, which makes them particularly powerful. There are several tax credits that could be available to you as a retiree. Here are 3 of them to be aware of. 1. The Child Independent Care Credit. If you're a retiree who is also caring for a dependent, such as an aging parent or grandchild, you might qualify for this tax credit. The credit gives you back a percentage of the costs you spend for necessary care up to certain limits. 2. Medical Expense Tax Credit. If you have high out-of-pocket medical expenses in any given year, you may be able to take advantage of this credit. You could deduct medical expenses that exceed 7.5% of your adjusted gross income. Lastly, the Residential Energy Tax Credit. If you make certain energy-efficient improvements to your home, you may qualify for this credit. It applies towards qualifying projects like installing energy-efficient windows, doors, or heating and cooling systems. It's important to note that tax laws can be complex and change frequently, so always consult a tax professional or a certified financial planner to understand how these and other tax credits could apply to your situation. Taking the time to identify and utilize all the tax credits available to you can significantly lower your overall tax burden and help preserve your wealth in retirement. As we've just reviewed, you can see that taxes can significantly impact your retirement income. But with careful planning, you can manage your tax burden and potentially increase your income in retirement. A balanced approach to tax saving strategies is crucial. I hope you'll join us next time when we will discuss how to control your risk using insurance. Thank you for listening, and remember, we believe you can have a flexible life plan to achieve more of what you love. More financial confidence, more for your family, more freedom, more choices.